Achieving financial freedom is a goal many of us aspire to, but few truly understand how to reach it. Financial freedom means having enough money to cover your living expenses without relying on a regular paycheck. It's about having control over your finances, reducing money-related stress, and having the freedom to make life choices without worrying about how you'll pay your bills. But to get there, you need to develop smart money habits that will help you save, invest, and manage your wealth. Let's look into essential money rules that can help you achieve financial freedom. Number 1, spend less than you earn. At the core of financial success is the simple rule of spending less than you earn. This might sound obvious, but many people find themselves in financial trouble because they live beyond their means. When you consistently spend more than you make, it becomes almost impossible to save or invest for the future. Living below your means not only frees up money for saving, but also helps you avoid falling into debt. Create a budget to track your income and expenses. Apps like Mint or YNAB, You Need a Budget, can help you monitor where your money is going and identify areas where you can cut back. By knowing exactly how much you earn and where you're spending it, you can make conscious decisions to reduce unnecessary costs. Additionally, categorize your spending into needs and wants to make more intentional spending decisions. Needs should include essentials like housing, utilities, and food, while wants may include things like dining out or entertainment. Focus on cutting back on wants to stay on track. Number 2, build an emergency fund. Life is full of unexpected events, whether it's a sudden car repair, medical emergency, or job loss. An emergency fund serves as a financial safety net, allowing you to handle these unexpected costs without going into debt or derailing your financial goals. Without an emergency fund, you may have to rely on credit cards or loans, which can increase your debt burden. Start by setting a goal of saving $1,000 in an easily accessible account, and then work toward building a fund that can cover 3-6 months of living expenses. Set up automatic transfers into this fund from your checking account to make saving effortless. To accelerate your emergency fund savings, consider funneling any extra income, such as bonuses, tax refunds, or side hustle earnings, directly into the fund. This way, you can reach your goal faster while ensuring you're financially protected. Number 3, invest early and regularly. The earlier you start investing, the more time your money has to grow thanks to the power of compound interest. Compounding allows your investment returns to earn returns themselves, leading to exponential growth over time. Even if you can only invest a small amount at first, starting early gives your money more time to grow. Regular contributions to your investment accounts are just as important because they keep your portfolio growing steadily. Automate your investments by setting up regular contributions to your retirement accounts, 401k, IRA, or brokerage accounts. You don't have to be an expert. Start with low-cost index funds or ETFs, which offer diversification and long-term growth potential. Also, consider the rule of 72 inches to help visualize the power of compounding. Divide 72 by the expected annual return on your investment, and that's roughly how many years it will take for your money to double. For example, if your portfolio grows at 6% per year, it will double in about 12 years. Number 4, avoid bad debt. Debt can hinder your path to financial freedom, especially high-interest consumer debt like credit cards or payday loans. This type of debt can quickly spiral out of control, making it difficult to save or invest for the future. While some debt, such as a mortgage or student loans, can be considered good debt if it helps you build wealth, high-interest debt should be avoided or paid off as soon as possible. Focus on paying off your highest interest debts first, such as credit cards or personal loans. Use the debt avalanche method, where you tackle the highest interest rate debt first, or the debt snowball method, where you pay off the smallest debt first to build momentum. Another useful strategy is to negotiate lower interest rates on your credit cards. Contact your credit card company and ask for a reduced rate, especially if you've been a loyal customer with a good payment history. This can save you money and interest and help you pay off your debt faster. Number 5, automate your savings. Saving consistently is one of the most reliable ways to build wealth over time, but it can be easy to forget or procrastinate. That's where automation comes in. By setting up automatic transfers to your savings or investment accounts, you ensure that saving happens without you having to think about it. Set up an automatic transfer to your savings account each time you get paid. Even if you start with a small amount, consistently saving will help you build wealth over time without needing to rely on willpower. Additionally, consider automating your bill payments to avoid late fees and penalties. This simple action can improve your credit score over time, which may lower your interest rates on future loans and save you money in the long run. Number 6, diversify your investments. Diversification is key to managing risk in your investment portfolio. By spreading your investments across different asset classes, stocks, bonds, real estate, and even cash, you reduce the risk of losing money if one area underperforms. A diversified portfolio helps smooth out returns and protects your overall wealth from market volatility. Start by investing in a mix of stocks and bonds through index funds or ETFs. As your portfolio grows, consider adding other asset classes like real estate through REITs or commodities to further diversify. Rebalance your portfolio periodically to ensure it remains aligned with your financial goals. If one asset class performs better than others, you may find your portfolio becoming too heavily weighted in one area. Rebalancing ensures you maintain the right mix for your risk tolerance and long-term objectives. Number 7, keep learning about personal finance. To achieve financial freedom, it's important to continuously learn about personal finance and investing. Financial literacy empowers you to make informed decisions, avoid costly mistakes, and recognize opportunities for wealth building. The more you understand about managing money, the better your chances of achieving your financial goals. Make a habit of reading books, blogs, or listening to podcasts on personal finance. Some great books to start with include The Simple Path to Wealth by J.L. Collins and Rich Dad, Poor Dad by Robert Kiyosaki. Staying informed will help you make smarter financial decisions. In addition to reading, take free or low-cost online courses on topics like investing, budgeting, and tax strategies. Platforms like Coursera or Udemy offer comprehensive courses that can deepen your financial knowledge and improve your money management skills. Number 8, plan for retirement. Retirement might seem far away, but the earlier you start saving, the easier it will be to reach your financial goals. Retirement planning involves setting aside money in tax-advantaged accounts, such as a 401(k) or IRA, and letting it grow over time. The earlier you start, the more time your money has to compound, giving you financial freedom in your later years. Contribute to your 401(k) if your employer offers one, especially if they match your contributions. It's essentially free money. If you don't have access to a 401(k), consider opening a traditional or Roth IRA and contribute as much as you can each year. To maximize your retirement savings, try to increase your contributions by 1% each year, especially if you receive a raise. This small, incremental increase can significantly boost your retirement nest egg over time without a noticeable impact on your current lifestyle. Number 9, avoid lifestyle inflation. As your income increases, it's tempting to upgrade your lifestyle, buying a bigger house, a nicer car, or more expensive clothes. This is known as lifestyle inflation, and it can prevent you from reaching your financial goals. By keeping your spending in check, even as your income rises, you can save and invest more, helping you achieve financial freedom faster. When you get a raise or bonus, avoid the urge to immediately increase your spending. Instead, increase your savings or investment contributions and allow yourself a modest treat as a reward. This will keep you on track for your long-term goals. Track your spending over time to ensure lifestyle inflation doesn't creep up on you. If you find your spending is increasing in line with your income, adjust your budget to allocate more money to savings and investments. Number 10, track and adjust financial goals regularly. Setting financial goals is important, but it's equally important to track your progress and adjust those goals as needed. Life circumstances change, and your financial goals may evolve over time. Regularly reviewing your financial situation ensures that you're on the right path and allows you to make adjustments to stay aligned with your long-term goals. Break larger goals into smaller, more manageable steps. For example, if your goal is to save $50,000 for a home down payment, set milestones like saving $10,000 by a specific date. Periodically review your progress and make changes if necessary to stay on track. Create a visual representation of your goals, such as a chart or graph, to track your progress. Seeing how far you've come can motivate you to stay committed and achieve your financial goals.